Hey there, investing enthusiasts! Today, we're diving into the balance sheet. Think of it as a financial snapshot, revealing a company's assets, liabilities, and equity. It's one of the three major financial statements, alongside the income statement and cash flow statement. Why should you care? It helps you understand a company's financial strength and stability. By analyzing the balance sheet, you can gauge a company's ability to meet obligations and fund growth. Imagine you're about to lend money to a friend. You'd want to know if they can pay you back, right? That's what the balance sheet helps you determine for companies. It provides a clear picture of their assets, what they own, and liabilities, what they owe. Understanding its components empowers you to make smarter investment choices. Now let's break down the balance sheet into its components: assets, liabilities, and equity. These elements are linked through the accounting equation. Assets equals liabilities plus equity. Assets are what a company owns, like cash, inventory, or property. They can be tangible or intangible, like patents and goodwill. Assets are listed in order of liquidity, with cash at the top. Liabilities represent a company's obligations to others, like debts owed to creditors. They can be short-term, like accounts payable, or long-term, like bank loans. Understanding liabilities is crucial for assessing financial risk. Equity represents the owner's stake in the company, the residual interest after deducting liabilities. It includes contributed capital and retained earnings, the accumulated profits reinvested back into the company. Raw numbers on a balance sheet tell a story, but financial ratios help us understand it. These ratios, calculated from balance sheet figures, provide insights into a company's liquidity, solvency, and efficiency. Liquidity ratios measure a company's ability to meet short-term obligations. The current ratio, current assets divided by current liabilities, indicates if a company can cover its short-term debts. A higher current ratio suggests better liquidity. The quick ratio, liquid assets divided by current liabilities, excludes inventory, offering a conservative view of liquidity. Solvency ratios assess long-term financial stability. The debt-to-equity ratio, total debt divided by shareholder equity, measures the proportion of debt to equity. A high debt-to-equity ratio indicates higher financial risk. The interest coverage ratio, EBIT divided by interest expense, measures a company's ability to cover interest expenses. Efficiency ratios evaluate how effectively a company uses its assets to generate sales. The asset turnover ratio, net sales divided by average total assets, measures asset efficiency. Section 4. Spotting trends, analyzing performance over time. Analyzing a single balance sheet provides a snapshot, but trends over multiple periods offer deeper insights. Compare balance sheet data from different periods to identify patterns and changes. Track changes in assets, liabilities, and equity to spot potential red flags or positive developments. For instance, a consistent increase in debt-to-equity ratio could indicate growing financial risk. Conversely, a steady increase in retained earnings might suggest a profitable company reinvesting for growth. Section 5. Benchmarking success. Comparing with industry standards. Comparing a company's performance to its industry peers, known as benchmarking, is essential. Industry standards provide a benchmark to assess a company's performance. For instance, a retail company with a low inventory turnover ratio might have inventory management issues. A higher than average current ratio suggests better short-term liquidity. Remember, industry averages are benchmarks, and deviations don't necessarily indicate a problem. Consider factors like company size, location, and competitive landscape when comparing to industry standards. Section 6. Conclusion: the power of balance. Sheet analysis. Mastering balance sheet analysis is invaluable for making informed investment decisions. Understanding the components and key financial ratios provides insights into a company's financial health. Regularly reviewing and analyzing a company's balance sheet offers a comprehensive view of its financial strength. Combine balance sheet analysis with other financial statements for a complete picture. Keep learning, keep analyzing, and never stop seeking investment opportunities.